Ladies and gentlemen, good morning and good afternoon. Welcome and thank you for taking time out to listen to us. I believe that you will find the subject matter today both important and interesting. Please take note of the safe harbor statement. There's a substantial amount of forecasted information and assumptions in this presentation. There are a number of presenters today. First up, let me say I'm very pleased to introduce Charles Carter, who has joined the Sibanye-Stillwater team as a C-suite member responsible for the Americas region. Charles will provide a fresh perspective. After Charles, Wayne Robinson, the Executive Vice President for the Montana operations, will provide a detailed technical review, followed by Peter Henning, the Senior Vice President Finance. He'll cover the cost and financial aspects. I'll lead the presentation, providing the context to the repositioning of this Tier 1 asset, and then I'll wrap up with a brief conclusion. In terms of the context, I'd like to ensure that you're all very aware that we are focused on value. We are very disciplined when it comes to value. So I intend to start this presentation with a value discussion. Now, the transaction overview as it was presented in 2017 is this exact slide that you're seeing now. I don't really want to focus on the right-hand side of this slide, but I'd like to focus on the left-hand side of the slide under the heading of consideration. After extensive due diligence and very substantial negotiations, we eventually paid 18 Rand, sorry, correction, 18, I wish it was 18 Rand, $18 per share in cash for all the outstanding common stock of Stillwater. So that amounted to a total amount of $2.2 billion. The total consideration was $2.7 billion. This included the acquisition of about $500 million of cash and the repayment of about $500 million of convertible notes with a make whole. You would remember at the time that we arranged a finance bridge of $2.7 billion as well, and that financing came from Citi and HSBC. Towards the end of the presentation, I will certainly focus on how many boxes we can tick regarding the transaction rationale. But essentially, the point that I'm making here, or would want you to remember as we talk through this presentation, was the amount of $2.2 billion. So we've never shown the next slide, but this was the Stillwater valuation considerations at the time of acquisition. On the left-hand side of the slide, you can see a sum of the parts evaluation, and that's run at a discount rate of 5%, and at the time was done on very conservative commodity basket prices. However, the point I want to make on this slide is when you look at the right-hand side in the grey bar, Blitz was at a conceptual level from a project point of view, and we felt it needed to be risk adjusted. So we actually, our final point of view was actually running the the Blitz net asset value at a 10% discount rate, and risk adjusting it in that fashion. And you will note that the total group NAV came in at $2.9 billion, with Blitz having a value of just over 700 million. Now, clearly, if you're paying 2.2 billion, if you deduct the 700 million value of Blitz from the 2.9 billion for the total group, it essentially means that we paid for the existing operations, and Blitz was acquired at zero cost, and that's how we saw the risk of this transaction, is that we paid full value in our minds for the existing operating assets, and Blitz was upside, as well as the palladium price, which I'm going to get to now. So if you look at the return on investment, this was largely determined because of the transaction that we were able to negotiate. It was largely determined by our exposure to the palladium price, and you can see when we announced the Stillwater transaction, I dare say was at a low in the PGM commodity price cycle, and I dare say that our timing was impeccable, and it was not luck. We could have done Lonmin when we did Stillwater, and we chose to do the Stillwater transaction based on our understanding of the palladium market balance, but also based on the work we had done to understand that the Russian palladium stockpiles were actually going to be quite sticky going forward, and therefore we really wanted to increase our exposure to palladium at that point in time. As we all know, we've had very significant operational disruptions, starting from 2018 when we had the Benbow flooding. I'm not going to go through all these in detail, and I'm really referring to those operational disruptions, including COVID, in the blue circle. But these have been significant setbacks, and have caused a significant delay to the build-up at Blitz. And not only have they delayed the project, they've also caused operational flexibility issues. Now, despite that, when we look at the payback of these assets, whether you look at it in dollar terms or in rand terms, in less than 5 years, these assets have paid for themselves. So I suppose the message is there's very significant value upside and operational opportunity, or optionality, I should say, looking forward. The payback here is shown in a cumulative adjusted EBITDA, obviously the stream proceeds, less the capital, plus what we call the recycling advances. And you can see the payback to date in the blue bar on both sides, in dollar terms and in rand terms. So payback in US dollar terms has been 1.2 times, and payback in rand terms has been 1.37 times. So this despite the operational setbacks, these assets have been a good investment, with very significant optionality looking forward. When we now look at the right-hand side of the diagram, we can see a number of macroeconomic challenges in front of us. And again, I'm not going to go through these in detail. Both Charles and Wayne will cover them, but things such as skill shortages, rising global inflation, supply chain constraints, a deteriorating global economic outlook, more extreme weather events. We know we've just had a 1 in 200 year flood at Stillwater, which we will provide updated guidance at the end of this presentation. These are all things that we now need to factor in to our business in the US looking forward. You would also note that what we refer to the grey elephants at our presentations in February of this year referred to the angry planet, multipolarity, the big squeeze, and so on. And these things are now starting to feature. As you will see from this repositioned plan that we're presenting today, I believe we're on the front foot in ensuring that we come up with an optimum commercial position. Just looking at the palladium market itself, this is not new information, but certainly as we start looking forward, we become, let's say, more confident in the fact that the palladium market will move into a surplus in the middle of this decade. And that's going to, of course, lead to potential price weakness a few years later. And therefore, it doesn't seem to make good or smart commercial sense to spend millions of dollars on a capital project which will deliver into price weakness somewhere in the future. That just does not make sense. And hence, when you couple our view of the palladium market plus the macroeconomics that we're going to be dealing with going forward, means we really need to reconsider what's the best way to extract value from this asset. So the bottom line is this: the prevailing macro environment and changing palladium market conditions have prompted a strategic revision of the US PGM operations and our previous expansion plans. As I've indicated, it's prudent to defer capital investment on the original growth project and re-engineer the operations to protect margins and long-term value. So with that, I'm going to hand over to Charles Carter, the Chief Regional Officer for Americas. Charles has been with us literally for a few months, and he will offer what we call a fresh perspective. Thank you, Charles.
Thank you, Neil, and good morning and good afternoon. Let me just start with the first insight on this slide, which talks about an angry planet, an extreme weather event in Montana. The grey elephant is a sort of scenario planning tool that we use in the company, and it represents a highly probable, high impact, but often neglected catalyst. And we've obviously had one recently globally with COVID, and now we've had it with an extreme weather event in Montana. And the point of the sort of grey elephant scenario around this is not so much that of the event, it's really, is the organization resilient in dealing with grey elephant events? And so, you know, my first overriding impression, new in role, and it's just come up for 8 weeks now. And at the end of the second week, we had this significant extreme weather event, 1 in plus 200 year flooding event in Montana. You know, the first insight is this organization resilient in facing this crisis? And for me, it's although it's been a difficult way to start and more difficult, obviously, for owners and shareholders of the business in seeing lost production, and I'll come to that discussion. It's been an unbelievable way to understand the resilience of the teams in role against a difficult context. I think most importantly, as we went into the flood event on the 12th and 13th of June, which is coming off a weekend production cycle, the teams did a very orderly shutdown. There were absolutely no incidents safety related, both on site and in the surrounding communities. And the teams on site at Stillwater Mine had to do a lot of rescue with local campers who were camping in the weekend in the surrounding national forest. Really excellent work done throughout on orderly closeout, safety, and community engagement. And then what followed immediately in the crisis of the flooding was substantive collaboration across all stakeholders. So not just immediate neighbors to the operations, but the county itself, Stillwater County, had significant damage impact throughout the county. There have been daily engagements with county officials to support not just the interests of our operations, but to support the whole county in its dealing with the flood. And then from county through to state regulators, and then through to federal regulators, there's been a very substantive set of engagements. So I think from a stakeholder management perspective, it's been a really good insight into both the robustness, resilience, and the integrity of those engagements. And so we've had multiple meetings as a team with everyone from Governor Greg Gianforte, Governor of Montana, the Senators Tester and Daines, who are in the state Washington Senate, and then representatives in the House, such as Matt Rosendale, and we've even had congressional delegations on site in the last couple of weeks visiting. These have not been meet and greet. These have been substantive dialogues around how to address the impact of the flood in the greater region, the importance of these operations to the state of Montana, and then dealing with infrastructural activities to rehabilitate. And so my overriding first impression is this is a team with great collaboration. It's a team with deep relationships that matter at all levels of stakeholders. And they've come out with flying colors. The flood event itself, you would have seen from our disclosure to the market, East Boulder mine not directly impacted by flooding, and similarly the Columbus Met plant not directly impacted. However, both operations did have individual disruptions to employees' homes impacted by flooding. And so in that first week post-flood, both those operations had incremental impact. Stillwater mine itself very directly impacted. Importantly, not the assets, not the integrity of the assets, be it the operation, be it the plant, and be it the tailings. But you will have seen on that opening visual, the photograph in the introductory slide to this set of presentations, that's Stillwater mine, and you will see that the Stillwater River runs right through it. And so at the actual mine site, you've got the east portal on the left side, and you've got the rock dump, and so you've got production coming out of the east portal, and then you've got from the west side, where you've got the west operations, you've got rock dump material going the other way, and on both you've got men and materials in multiple directions. So that bridge was knocked out, and then importantly, right at the entrance to the operation, which you can see in the photographs on this slide, the whole access road was completely taken out. That is still the case right now, but there's been a workaround, which you can see in the above photograph, where we've gone onto private land, rehabilitated a temporary road, rehabilitated tailings and water piping, and so that's allowed us to get back into production. and we've just started production slightly ahead of planned schedule. But the net impact has been a significant one of 7 weeks no production at Stillwater mine, and that, as you know, accounts for around 60% of mine production. It has had an incremental knock-on effect to the recycling at the Columbus Met plant, because the recycling feed is blended with the cons from the two operations, and the operating cons sets the limits on what you can do on the recycling side. So you will have seen a step down in recycling through this period, but importantly, both East Boulder and the Columbus Met plant have really stepped above and beyond what's been happening to try and mitigate as much as possible the loss of Stillwater production. So I think from a resilience perspective and from a team integrity and capability in the face of a crisis perspective, for me, it's been a really good start to understand that level of resilience and capability in the context of a crisis. And I think hats off to everyone for what they've done. Talking about the team itself, there were a number of changes made prior to my arrival, and this was both to strengthen the technical side, the finance side, and the HR side. I've arrived into a very capable team. It's got great experience in all critical areas, and we've got good, strong operating leadership, and we've made changes also at the operating team level over the last 12 months or so. So, I mean, for those of you who are familiar with these operations, you will see some new faces. I think importantly, it's very experienced. It's a highly capable leadership team. We've also had one very recent change, which you will see on the recycling operations. So Justin Froneman is currently on gardening leave and has elected to take up a CEO role of a privately held integrated PGM recycling business, and he will do that coming off this month. I just want to give a shout out to Justin. He's done an incredible job, both in relation to the Stillwater recycling business, but also obviously to the global build of the recycling strategy. And very sorry to see him go, but wish him all the best in his new leadership role. And I'm sure he will talk to that at the right time in his own time. Importantly, Brian Stewart has just got feet under the desk in the last couple of days. So new in role on recycling. And I think it's going to be great to work with Grant. Very excited about that. And I think it's testament to the Sibanye talent pipeline that there's a strong and deep bench across the business with people able to step up into new roles. So that's been really good to see. So the second key insight for me is this is a strong, capable, and experienced leadership team covering the right sets of issues. And obviously, my focus is how to support them in all the ways necessary to make them really effective. The third insight is really one around context. We do have a rapidly changing macro environment in the US. This will be familiar to investors. You've seen high inflation, that's well understood. You've seen constrained supply pipelines. You've seen a very tight labor market, extremely tight. And you've seen this at the macro level, and you've seen it at the local level. And that has a number of knock-on impacts on the operations. So we've been revising our plan in the context of a lot of labor turnover and importantly in critical skills areas. This is not unusual to other mining businesses in North America right now. It's somewhat compounded in the Montana context because these operations have long travel times to site. And there's a lot of regulation around how we do that with busing of team members. There's a real lack of housing proximity to site, and there's a very expensive housing market. So to retain people and give them opportunities is not easy in that context locally. And so you will have seen there's high turnover, and Wayne will talk to that in terms of how it's impacted productivity. But I think importantly, this is a critical piece. The sort of HR training, development, and retention piece is a critical piece to the success of these operations on an ongoing basis. And right now, it's a tough context. What you will see in this plan that we're presenting today is it's not just a near-term fix on the pressures that are facing the business. It's really trying to stand up a medium-term focus on all the things that matter to do justice to this world-class ore body. We've got 26 miles of strike on a truly unique geology. I think investors and analysts will have been frustrated historically by the promise and the various underdevelopment or underdelivery over a long period of time, even prior to Sibanye's ownership. And so in this plan, we've really tried to do justice to the longer term optionality of these assets. We're working hard across multiple fronts to get productivity improved, to get costs right, and to make sure we've got a sustainable business going forward. And it's going to take time to get that right, but this is a plan in the medium term that really drives towards the 700,000 ounces of production. And I think we can do better than that over time, but we're not going to overpromise now. So the question really is the multiple interventions needed to stabilize and then to optimize and to have leverage on these core assets going forward. And Wayne will talk through some of the challenges we've got technically on ground conditions, which has also led to backfill challenges and then changing mining methodologies. And there's a level of complexity around that. It's well in focus and it's well in hand on how we move that forward. He'll also touch on the skills and turnover issues, and Peter will touch on the costs and the capital. But what we are presenting here, we believe, is a very solid approach to how to get this stabilized and how to get it optimized and how to give it the time needed to allow our leadership teams operationally to get on the front foot. And I think, your takeaway should be that there's no silver bullet here. This is a multi-factor, quite complex set of integrated interventions that are going to take a bit of time to get right. And our focus is really the longer term delivery that is sustainable and really does justice to the opportunity here. And I firmly believe that we're presenting a medium-term plan that will get us there. It's realistic, it's achievable, and it'll certainly be sustainable. And I think for me personally, it's an exciting opportunity to come in to help these teams deliver on this. And I firmly hope that over time, you will see opportunity and upside on what we're presenting. So with that, let me hand off to Wayne. Thank you.
Thank you, Charles, and good afternoon and good morning to everybody, and thanks for joining this session this afternoon. Neil has already spoken about some of the historical operational disruptions and some of the macroeconomic factors that have ultimately resulted in us doing this repositioned plan for the Stillwater operations. Charles has also covered some of the operational impacts more recently, with the flood. He's covered that in quite a bit of detail, and I guess just to point out that the Stillwater mine is back up and running and has been running since the end of end of July. I'm going to go into a bit more detail on some of these impacts and you know what they mean to each one of our different operations, being the East Boulder mine, the Stillwater West mine, and then the Stillwater East operation, or what has historically been known as the Blitz project. If I move on to East Boulder, I guess one of the key things about East Boulder is that it has historically had reasonably consistent delivery. And I think really at the outset want to highlight, you know, one of the key reasons for that consistent delivery at East Boulder is its developed state. Now, when we talk about developed state at these operations, we're talking about mining blocks having all primary development and secondary development in place to allow for mining of that block. In more recent times, however, there have been other impacts, and more specifically in late 2021 and in the first half of 2022, we've had significant impact, you know, as a result of very high levels of attrition at the East Boulder operations. And again, more specifically, I talk about our miners and our geologists, who are key technical support staff for the mining operations. In fact, at these operations in the last year, we've sort of peaked at attrition rates of around 20% in some of those critical skills. What this means is we end up having less experienced miners and geologists on the face that have to deal with mining. And as I've highlighted on that section, I can just point it out. If you look at the section on the western side of the East Boulder operations, we are transitioning to more complex geology and more geotechnically challenged ground, and having to move inexperienced miners and geologists in there has a direct impact on our productivities as well as on our grade. And again, just to put it into some context, our miners, you know, by virtue of the fact that they do mechanized mining, they perform all functions of mining. In other words, they do the support, they drill, they blast, they clean. You know, they're extremely productive, and you know, experience plays a huge part in their levels of productivity. The geologists in turn make sure that they remain on the ore body, and in the case of having inexperienced people, as I've already highlighted, that does have a direct impact. What we've done to really offset this challenge is we've increased the amount of training that we're doing at both sites. We have between 30 and 40 miner trainees in our training centres. This has been stepped up significantly from historical levels, and then there's also a big focus on you know, training and supervision to ensure that we can get back up to the previously seen production and productivity levels. So we expect by the end of 2022 we'll be back at historical levels, and then from there we build up to around the 230,000 ounce level going forward into the future. If I look further down that slide, I'm going to refer specifically here to the sustained business capital. One of the key areas there is to make sure we sustain our 18 months of developed state. But I think more importantly, two other impacts that are impacting on the costs, and this is on the sustained business capital, should I say, and this applies to both operations, and Peter will probably go into a little bit more detail on this as well. But we have made quite a significant investment and a decision to fast track some of our investment into replacing and upgrading our fleet, you know, which has been an aging fleet. But more specifically, we are including advanced proximity detection, and I'll cover that in a little bit more detail when I talk to the Stillwater West operations, and other safety devices, together with the fact that the new modern equipment, you know, does have quite a big impact on our emissions and our diesel particulate matter, or DPM, controls. So yeah, that is on the underground equipment. The second bullet there refers to the tailing storage facilities, and right now we have seen a significant increase in the cost of construction type work, which is the expansion of our tailings dam, and going into the future we're going to have a new waste rock dump that we're going to have to construct, as well as tailings facilities. Now, What is driving this increasing cost is really, it's a supply and demand issue with construction type work, where following the approval of the infrastructure bill, the $1 trillion infrastructure bill in the US, essentially we're competing for some of the similar skills, in the construction business, but obviously it's putting a huge demand on construction type of activities. So this has had a double impact, both on the attrition side, but as well as on the cost side of our business. And that's in the labor market in the US, where there's almost zero unemployment. So at East Boulder then, again, just to remind everybody, for the next couple of years in the staying business capital on our waste handling facilities. Currently, we are expanding our tailings facility, the existing one. In the next 2 to 3 years, we've got a waste rock that we're required to build. And following that, we have a new tailings facility, which needs to be constructed. So that obviously does put pressure on those staying business costs. If I move on to the Stillwater West operations, one of the key things that we've been challenged with at these operations is the level of developed state, which I already touched on, is in pretty good shape at East Boulder. Not quite the same picture at Stillwater, where it is less than 6 months. And I guess a couple of factors there. The key one being the fact that the development has been challenging in the 2 areas that I'm going to highlight now. That's in the depression zone, in that red circle, and then the development through the Stillwater fault, the blue circle on the eastern side of the Stillwater West operations. And really the challenges there have been, the fact that you've got a lot of development that you're doing and it's not yielding any ore body. It's just not improving the developed state as it happens. So that's one of the key challenges. The next one, and we discussed it, I think the last time we presented around these operations, was soon after we had the rail incident on 35 level. 35 level has been demarcated there with that black line horizontally across the slide. We have a concentration of our mining at this point in time to the west side, where we're doing probably 60% of our production, as well as having to develop or advance the mining front, the development front ahead of us, on a rail system which has been significantly constrained by the revised standard operating procedure. So I guess a combination of all of these, is what is providing the challenge for the developed state at the Stillwater West operations. So what are we doing about it? The investment into our equipment, upgrading our fleet from a proximity detection point of view, we believe will eliminate the constraints of that SOP. And at the same time, we've introduced a limited number of contractor support to do some of the development for us. That does come at a premium, and Peter will touch on that, when he goes through some of the cost slides. What we do see is that in the next, between now and 2024, we expect the developed state to improve to at least 12 months, and then going further forward to increase that to 18 months. That flexibility is what underpins the plan to get Stillwater West operations back up to the 300,000 ounces at higher levels of productivity than what we are currently seeing, and obviously at reduced costs. If I move over to the Stillwater East operations, as I said, previously known as the Blitz project. The first thing I'd like to say is we do have a developed mine on Stillwater East. The Benbow decline, which was flooded for about an 18-month period, that has actually intersected the 56 level. We do have ventilation infrastructure. We've got ore pass infrastructure, ore handling, waste handling infrastructure. We've got rail. So in essence, a mine has been developed, over the last number of years. What has been disappointing, as Charles has said, is the levels of increased production. Although I do need to point out that Stillwater East has delivered increased production over the last couple of years, just not necessarily at the rate that we've all anticipated. I think a number of the operational disruptions, which I've certainly touched on, is what has had an impact on the developed state at Stillwater East, which is a challenge, as I've said. Plus the cost of these additional contractors, which I've spoken about at Stillwater West, that also applies at the Stillwater East side. So really, we're in a position now where a certain amount of development has been done. We've done a lot of additional definition drilling off these footwall drives, and what that footwall drilling is showing us is that we require a long-term engineering full solution for the Stillwater East side of the mine, and this is it's based on two key factors. The one is that we have a wider ore body in certain areas than what was anticipated, and we also have ground conditions which require us to use an overhand cemented full support solution, as opposed to the very productive ramp and fill, where you would just mine on the sand that you place below you as you mine. So really, our preferred mining method in these ore bodies is this overhand ramp and fill. Very cost effective, very productive, but in challenging ground and in the wider type of ore body, we are required to move towards having an overhand cemented fill that we could then work under, and really driven to a large extent from a safety perspective. So what we've been doing in the interim, and if you look at this diagram, we've been using a small cemented rockfill plant, but as a result of its limited capacity and the proximity to the mining front, which is moving further to the east and higher up in the mountain, we really need to have a long-term solution to this support. And what we've decided to do in this revised plan is to look at suspending all the mining areas that require cemented fill until such time as we can complete the installation of a backfill plant, and we expect that to take the next 2 to 3 years at a cost of around $30 million. Now, immediately, that has an impact of around 40,000 ounces in 2022. And as I've said, that plant would take 2 to 3 years to build. So it has an ongoing impact. But beyond that, obviously, we would then be able to come back and mine these areas where we've exposed a wider ore body in some of the challenging ground conditions. What it has allowed us to do in the immediate short term is to restructure or to take out some of the some of the cost impacts of this very costly and low productivity CRF solution, and that has been built into the numbers going forward. Similar to the Stillwater West and the East Boulder operations, you can see a very determined focus on making sure we get our developed state to over 12 months by the end of 2024, and then to continue to build that to 18 months over the longer term. That really concludes the technical discussion around these operations, and I'd like to hand over to Peter Henning, who will run through some of the cost impacts as a result of this restructured plan. Thank you.
Thank you, Wayne, and good day, everybody. As highlighted, I will give some analysis to the cost and guidance going forward to our cost metrics. To get some context and understanding of our 2022 cost base, we need to understand that the units of production is obviously lower, as impacted by the flood impact, as highlighted by Wayne, and then also the stopping of the CRF on the eastern side that drives some lower production. Associated with those, there is cost that reduced over the period, and it allowed us to reduce some of our fleet and labor through natural attrition. These restructuring of the cost is mostly done, but it's unfortunately factored in for 6 months into our cost base. In addition, in the past, we were allowed to capitalize certain operating costs and overheads associated with the project under the Blitz project and seen as growth project for accounting purposes. Now, those costs associated with the project
has now been historically classified as growth, therefore forming part of all-in cost and not part of all-in sustaining cost. With the reduction of growth activities on the eastern side and the review of our strategy, we unfortunately can't capitalize those costs to the growth project anymore, and those costs will naturalize into the sustaining business of our cost structure as part of either working cost or reserve development and stay in business capital. We expect that there is about $40 million of cost that was historically capitalized in 2021 to the growth project that now will form part of this cost basket that's now part of all-in sustaining, and that increase our unit cost about $88 an ounce. In addition to this change of accounting treatment, as mentioned by Wayne, we do make use of contractors for development. The contractors do come at a premium. They cost, they've got a bigger crew and fleet cost associated to their activities, and therefore it's got a direct impact on our ORD numbers as presented for this year and going forward. We do have a strategic intention to reduce our reliance on contractors in the short to medium term, but it does add some risk to the downside if we do not achieve that switch over to local and own labor, as highlighted through our training by Wayne. Currently, the US is also experiencing inflationary pressures around 9% nationally, and these costs do come through into our cost baskets. We do have initiatives and strategies to reduce that cost by strategic sourcing and also through the activities of standardizing our fleet and fleet replacement, as Wayne has mentioned, under the capital side. We've historically also indicated as part of last year's Investor Day that our royalties do have an impact on all-in sustaining cost. The higher the market price, it does have a $9 an ounce per $100 impact, and obviously those costs will filter through into our all-in sustaining cost, especially based on current market conditions. If we look at a longer term analysis of our cost and guidance going forward, you will see there's a significant drop-off in our cost base over the next 3 to 4 years, and then stabilize below the $1,000 an ounce. And especially in the last 3 to 4 years, we're dropping down to the $950 to $990 an ounce over life of mine as we achieve at the 700,000 ounce production. Now, as highlighted in the previous Investor Days, obviously there's a big component of our working cost. Working costs do come down as our production increase, but the main objective here is keeping our eye on dollar per ton. The objective here is to get our dollar per ton in line with 2018 levels, and those we do expect to be achievable as we progress with some of the initiatives. But as highlighted, it is dependent on reduction of contractors and also the success on our strategic sourcing activities. If we look at other cost pressures and over the next couple of years, we do see ORD has got a significant component over the next couple of years, especially up to 2027. That is as we increase our plant developed state and the investment into that does drop off to more levels of around $145 an ounce to 27. And then subsequent to that, but in life of mine, that drops down to $50 an ounce as the ore body gets fully developed and we maintain our production profiles. Similarly, as I stay in business capital is a significant investment over the next couple of years, especially in 2023, where we do see a significant cost contribution on capital. That will be mostly driven as a result of capital rollovers from the 2022 levels, because we couldn't execute on most probably on all our capital during this period, impacted by the flooding event, and obvious as we finalize this replan, some of that capital has been delayed to make sure we spend our dollars on the right buckets. Over the next 3 years, we do spend quite a bit on our infrastructure, power systems, and underground infrastructure, and that is to de-risk the underground environments. And also, as highlighted by Wayne, East Boulder and Stillwater has got investment into waste rock dumps and tailings facilities. Stillwater's tailings facility is kicking in 27 to 2029, and that's why you see that elevated capital continued spent during that period, after which from 2030 the capital reduced to around $75 an ounce. So our capital spend over the next couple of years is driven by our life of mine, and obvious as highlighted by Wayne, de-risking the production profile. If we look at the growth capex, that's a significant change from what we've presented last year in the investor update. Historically, we would have completed the project by 2024. That has now been reviewed as part of this strategy, and the cost has been reduced, and the project will mostly be completed by the Q1 of next year as originally scoped. The expected cost expenditure for this year remains $70 million. That was a couple of rollovers that came from 2021, but also now the completion and finalization of the Benbow and rehabilitation of the Benbow site, and associated completion of this concentrated plant at Stillwater that is expected in Q1 of next year. New growth capex that we've added to the profile, and that is mostly in 2023 and 24, is associated with this engineered backfill solution that Wayne has highlighted. I think in conclusion, there's quite a significant investment over the next couple of years into the ore body, our infrastructure, and equipment, while we will see the benefit of that cost matrix dropping down to below the $1,000 an ounce, which should give us sustaining margins going forward, while we keep a keen eye on our operating cost and making sure we don't lose the ball on that. With that, I hand over to Neil for the conclusion. Thank you, everybody.
Thank you, Peter. Let me wrap up today's presentation. I think the first thing I want to say, when you look at this profile, we've been able to retain a significant but lower build-up at a much lower targeted cost. You will note that it takes a number of years to achieve this, but in our view, the Stillwater operations will be well positioned to be sustainable through the commodity cycles. As you've heard, there's very substantial technical work that has been done that underpins this plan. When you look at updated guidance for 2022, I think important to note that we've included the stoppage that we had to undergo as a result of the flood. In terms of underground production, from the US PGM operations, production guidance is now about 450,000 ounces at all-in sustaining costs of just over $1,380 per ounce, with capital just over $275 million, which also includes project capital. We are lowering guidance on recycling. We are seeing constraints in the market, and production is forecast at just over 700,000 ounces. Correction, let me be clear, 700,000 ounces for the year, and we have got some capital expenditure there of $3 million. You can see the makeup of the change in guidance. Half of that is related to the flood impact, and the balance is related to the issues that Wayne and Charles have discussed. So in conclusion, we believe that this has been and is a transformative, value accretive investment. It has delivered on its strategic intent. The strategic intent was well set out in slide 1. Its return on investment has been secured. It's already paid back for itself, and we are now optimizing future value for all the stakeholders. We have a robust de-risk plan with much greater flexibility now having been built in. I think it's a prudent response to a changing environment. That environment, as we've outlined, is elevated inflation, substantial skills shortages, and of course we've taken account of our expected change in the commodity cycles with respect to palladium. As I've said, I'm pleased that focusing on margins, we've still seen very substantial growth to approximately 700,000 2E ounces by 2027. In terms of protecting margins, we have a plan that shows that the all-in sustaining costs will be below $1,000 per 2E ounce in the medium to long term. These assets still have 30 years of life, so long life assets with great optionality. And just to update the return on investment, the original investment, as I outlined at the beginning, was 2.2 billion. The estimated return so far is shown in the green, $2.6 billion. And the life of mine plan on the new plan that you've seen today adds another 3.2 billion. I think that is very substantial value creation for our shareholders. So the bottom line, we've repositioned this business for delivery of sustainable value through the commodity cycle. Thank you very much for your time and attendance. Myself, together with the rest of the team, will be happy to take questions. Thank you.